John Maynard Keynes lost a fortune in the 1920 currency markets, rebuilt it, lost most of it again in the 1929 crash, and rebuilt it a second time. And the detail that matters isn't the loss. It's what he wrote afterward. Dissecting his own mistakes with the same cold precision he applied to nations, that markets can remain irrational longer than a man can remain solvent. He understood something most investors never reach, at any account balance, that the obstacle was never information. It was his own nervous system, reacting to numbers the way body reacts to a threat, regardless of how many economics treatises sat on the shelf behind him. That single insight, that the enemy lives inside the investor, not inside the market, explains something almost nobody discusses honestly. The psychological experience of investing does not scale the way the dollar amount does. $100 and $1,000,000 are not the same problem at different sizes. They are entirely different problems, governed by different fears, different forms of self-deception, and different ways an institution profits from each one. Start small, because small is where the deception is most elegant. $100 in a brokerage app feels less like an investment and more like a lottery ticket dressed in financial language, low enough that losing it stings for an afternoon, not a year, which is precisely why it's the easiest entry point ever engineered. Robinhood, Webull, and a dozen imitators built entire business models on this exact threshold, gamifying the experience with confetti animations on trade execution and push notifications, timed to spike dopamine at the moment of greatest emotional vulnerability. Internal documents and subsequent regulatory scrutiny, including a $65 million settlement Robinhood paid to the SEC in 2020 over misleading customers about how its revenue actually worked, revealed what the confetti was covering for: payment for order flow, a practice where the platform sells a user's trades to market makers, profiting whether the user wins or loses. At $100, the platform does not need the investor to succeed. It only needs the investor to keep playing. Here is the invisible architecture sitting underneath that $100 account, and underneath every account above it. Scaled differently but never absent, the financial industry does not primarily sell returns. It sells the feeling of participation, because participation generates fees, spreads, and data regardless of outcome. A retail trader watching a stock chart at 2 in the morning, blue light washing across a dim bedroom, thumb hovering over a buy button, is not behaving irrationally by the standards of the system designed around him. He is behaving exactly as predicted, and predicted behavior, as in every system built on attention, is the actual product being sold to someone else entirely. Move the number up. $10,000 changes the psychology entirely, because now there is something real enough to lose. This is where Daniel Kahneman and Amos Tversky's research becomes load-bearing rather than academic. Their 1979 paper, Formalizing Prospect Theory, demonstrated, through carefully controlled experiments, that human beings do not weigh gains and losses symmetrically. A loss registers roughly twice as painful as an equivalent gain feels good. At $100, this asymmetry barely registers. The stakes are too trivial to trigger it. At $10,000, it activates fully. The investor who watched the position rise 8% and then retreat to flat doesn't experience that retreat as no change. He experiences it as a loss of the gain he'd already mentally spent, a phenomenon Kahneman's framework predicts with uncomfortable accuracy. This is the exact moment institutions know an account is most likely to make its worst decision, selling at the bottom of a temporary dip out of pure loss aversion, or doubling down on a losing position to avoid registering the loss as final. Neither decision is about the asset. Both are about the asymmetry sitting quietly in the investor's nervous system since long before they opened the account. Picture the scene properly. Kitchen table at 11 at night. Laptop open. Coffee long gone cold beside a half-eaten plate. A spreadsheet tracking a position that's down 4% for the third straight day. The investor isn't calculating expected value. He's negotiating with a feeling, the specific, physical discomfort of watching a number that represents 3 months of saved income tick downward in real time. The chest-tight sensation that has nothing to do with the company's balance sheet and everything to do with a cognitive bias formalized in a paper published before he was born. Nobel committees gave Kahneman the prize in 2002 for proving, among other things, that this man at the kitchen table is not an outlier. He is the median case. Climb further to $100,000, and a strange inversion occurs that behavioral economist Richard Thaler documented under the name the house money effect. Thaler's research, building on earlier work with gambling behavior, found that money won or gained is treated psychologically as fundamentally different from money earned through labor. People take far larger, far riskier bets with money they perceive as found or extra, even when a dollar is, in any rational accounting, identical to any other dollar. An investor who built an account to $100,000 over a decade of disciplined saving will often treat the first $50,000 as sacred and the gains above it as expendable, house money, available for the kind of speculative swing they'd never have made with the principal. This is precisely how serious capital ends up in volatile, unresearched positions. Not through ignorance, but through a mental accounting trick the brain performs automatically, sorting identical dollars into categories that feel different even though they spend exactly the same in a market crash. This is also the size at which the industry stops selling participation and starts selling sophistication, a different mechanism, aimed at a different vulnerability. Wealth management firms, hedge fund feeder structures, and exclusive investment clubs all cluster their minimum buy-in suspiciously close to the $100,000 threshold, because the psychology of the buyer has shifted from wanting access to wanting status. The fee structure changes accordingly. A 2-and-20 arrangement, 2% of assets annually, 20% of any gains, has survived in hedge fund culture for nearly a century, not because it consistently outperforms a low-cost index fund, which extensive academic research, including long-running tracking by Warren Buffett through his decade-long public bet against hedge fund returns, repeatedly shows it does not. It survives because exclusivity itself has a price, and the investor paying it is purchasing identity as much as return. Pause here is where the conventional wisdom about wealth and security breaks completely, and it breaks at exactly the threshold most people assume would finally deliver peace: $1 million. The cultural script insists that arriving at 7 figures resolves the anxiety that defined every smaller tier, that the kitchen table investor sweating over a 4% dip will, upon reaching this number, finally rest. Research into this specific population says almost the opposite. A widely cited 2019 survey conducted by UBS found that a majority of investors holding $1 million or more in investable assets did not consider themselves wealthy, and a significant share reported feeling that their financial situation remained precarious, not because the number was insufficient by any historical standard, but because the psychological reference point had simply moved with them. This is the same mechanism that recalibrates desire at every income tier. Except at $1 million, there is no salesperson left to blame. The investor has become both the merchant and the customer of his own dissatisfaction. Isaac Newton, the same mind that formalized the laws of motion governing the physical universe, lost a fortune in the South Sea bubble of 1720, buying in near the peak after watching the stock rise for months, selling early at a healthy profit, and then, unable to tolerate watching others get richer than him as the price kept climbing further, buying back in at a far higher price shortly before the collapse. He later remarked that he could calculate the motions of the heavens, but not the madness of men, and the madness he was describing was his own. Newton had more analytical capacity than nearly anyone alive in his century. It did not inoculate him. The million-dollar investor with a finance degree and a decade of market experience is not protected by competence either, because the failure point was never competence. It was the same asymmetric, data-sensitive, reference point-dependent machinery running underneath every tier, from the $100 gambler to the Cambridge physicist. What changes at $1 million is not the psychology. It's the stakes attached to the same psychology, and the sophistication of who's positioned to exploit it. The retail trader gambling $100 is exploited by an app's confetti animation. The investor with $1 million is exploited by people who speak fluently in risk-adjusted returns, alpha generation, and tax-efficient structuring, language precise enough to disguise the fact that the underlying behavioral trap, status-driven decision-making dressed as strategy, hasn't actually been solved. It's been institutionalized. The Machiavellian reframe sitting underneath all of this has nothing to do with discipline, and discipline is usually where this advice goes to die, because discipline assumes the problem is willpower rather than architecture. The actual leverage point is recognizing that every tier of investing comes preloaded with a specific, named, well-documented psychological failure mode, and that the entire financial services industry, at every price point, has built its profit model around that failure mode rather than around solving it. The $100 platform profits from your participation regardless of outcome. The $10,000 advisor profits from your asymmetric fear cycling you in and out of positions. The $100,000 fund profits from your appetite for exclusivity. The $1 million wealth manager profits from your inability to recognize that the goalpost moved the moment you crossed it. None of these are accidents of poorly designed system. They are the system functioning exactly as built. The strategic countermove, then, is structural rather than emotional. Refuse to let the dollar amount define the decision-making framework. Because the dollar amount is precisely the variable the entire apparatus is using to predict behavior. An investor who applies the same cold, rule-based criteria at $100 that they would apply at $1 million, position sizing rules, predetermined exit criteria, a refusal to let a gain be mentally recategorized as house money, is no longer legible to the systems designed around the typical emotional arc of each tier. Predictability is the actual commodity every one of these institutions is harvesting. An investor who declines to be predictable, at any size, stops being profitable to extract from in the specific way the architecture assumes. There is a colder layer beneath even that. Wealth, at every level examined here, was never actually about the number. It was about who controls the reference point against which the number gets measured. The gambler at $100 is anchored to the confetti animation's implied promise of easy multiplication. The kitchen table investor at $10,000 is anchored to the high water mark of his best week. The fund client at $100,000 is anchored to the exclusivity of the room he's allowed into. The $1 million holder is anchored to whoever in his social orbit holds slightly more. Anchor your own reference point instead, fixed. internal, indifferent to the market's daily theater, and the entire emotional machinery these institutions are built to trigger simply has nothing left to grip. Newton went back to physics after the South Sea bubble and never speculated in markets again, choosing instead to operate in the one domain where the variables stayed still long enough to actually master. He had calculated, correctly, that the problem was never the equations. It was a mind that could be moved by other minds, at any altitude, for any amount, the moment it stopped setting its own coordinates and started borrowing everyone else's.